Hi, my name is Steve Bick. I'm a hedge fund manager. I'm a chartered financial analyst, a certified management accountant, and certified insolvency and restructuring analyst. In this section, we're going to talk about capital market theory. That's really the first half of the session. And then the second half of the session, we're going to talk about your investment policy statements, and really private wealth management is the focus of that session. So we're going to break this into two. And let's start with capital market theory and a look at CAPM, or your capital asset pricing model. The first thing we need to look at for CAPM is really the assumptions under which CAPM actually operates. And the first one is that investor wealth, or your individual investor, their wealth is a small percentage of the total invested out there. So in other words, there's $12.5 trillion invested in the US markets, and investor wealth is really a small fraction of that. The second assumption that we have under CAPM is that we all, as all investors, so everybody, has an identical holding period. This is a relatively benign or ridiculous assumption, but for CAPM to hold, we all have identical holding periods. The other thing that the CAPM relies on is that we're limited to publicly traded investments only. It doesn't take into account any taxes or transaction costs. And here's the doozy of them all. All investors are rational. No one makes an error. We all think in exactly the same way. And we all are mean variance optimizers. And the last one is we all do the same analysis, and we have the same economic views. We have the same outlooks. We all look at things exactly the same. Now, those are the assumptions under which CAPM actually works and functions, and we're going to dig a little bit deeper into the theory of the capital asset pricing model, and then we'll move on to see how the arbitrage pricing theory can actually help or hinder that. So from these assumptions, we're all rational and we all have the same time horizon and we all look at things the same way. We obviously got to arrive at the same conclusions of what creates an optimal portfolio, and really that's what we're going to look at next. So here we have a diagram of the optimal risky portfolio, and what we have is the returns down on your y-axis, and on your x-axis you have your standard deviation, which is really a measure of risk. So what you have is the returns actually increase on this optimal portfolio on an efficiency frontier, and as this risk starts dropping, so the returns start dropping. And what we have on the left-hand side here on the y-axis is at the bottom you have a risk-free rate, because really you're not going to invest in anything less than a risk-free asset with a risk-free rate of return. So there's no standard deviation, there's no risk. You can put your money into your treasury bills and you'll be fine. And the tangent of the line from the risk-free rate to the efficient frontier, where it actually meets the efficient frontier, this is your market portfolio, and this is your optimal risky market portfolio. And at this tangent, you can see that this is the return that the market will provide you, and it will give you the standard deviation or the risk associated with that investment. So based on this efficient frontier that we get from that, it provides us with a market portfolio which falls on the capital market line, and really this is derived from CAPM and the assumptions that we have. So if we take this to the next level and you look at the market risk, you've got your ERM, which is really your risk of the market or the returns on the market. And if you subtract from that the risk-free rate, so this piece right here, you subtract the risk-free rate, because we're just trying to find out what the returns are that are attributable just to the market. So you subtract your risk-free rate, and what is the answer there is what you're going to have is you're going to have the average of all the investors. They're going to average degree of risk from all the investors, hence the line on top of the A for the average. And you're going to have the standard deviation of the market. And you're going to have this error term. And the reason that you have this term of 0.1 is because we look at this in terms of percentage and not just a normal number. So we take it to 0.01 because we want it to be a percentage. And this is going to be able to calculate the return on the market. So really what we're saying here is the return to the market is a direct component of this, is the risk involved with moving from a risk-free asset to a risky asset, which is based off the efficient frontier and provides us a market rate of return. If we move across and have a look at the stock, so each one of these, each stock that's within this portfolio that creates this market portfolio has its own returns that obviously are incorporated in the market return. So for a stock, and we're all aware of this is the classic CAPM formula, is the risk-free rate plus the beta of the stock, which is really the movement of the stock or the contributory factors that the stock adds to create the market portfolio, is captured in the beta. And then we have the risk of the market less the risk-free rate, which is this piece that we just captured. So in other words, your average to your sigma squared of the market is captured in this formula. So what we're trying to do here is we're trying to get an estimate. You have your risk of your market, you see how the capital market line is created, you see how it's actually structured, but now what you're seeing in a stock versus the market is the fact that the stocks have the beta factor, which is the risk factor, to try and determine what level of input or what type of contribution to the increase of the returns to the market portfolio are attributable just to that one stock. And really what we're saying is we take the market line or the market portfolio, we look at the variance of the market portfolio, and then whatever the movement of the stock is either above or below that, that really creates the beta, which creates the slope of the stock. But we'll dig into that a little bit more in detail now. So the fact that no one really uses these rationales, we all know that we're not all rational, we know that we all don't use the same time frames, etc., various assumptions of CAPM. Does that just make CAPM worthless? Well, let's have a look at that. Well, the one thing we're all fully aware of is that you have a well-diversified portfolio of stocks, that the specific risk that's inherent in each one of those stocks can be diversified away or can be shared. So you can just, if you get a well-diversified portfolio, you can actually eliminate a lot of that security risk and just be exposed to market risk. So if a portfolio actually moves with the market, it means that the betas have become relevant. Now, why have the betas become relevant? Of course, if you take the average of all the betas in the portfolio and you put them all together, the weighted average of all the betas in the portfolio, that beta should ultimately trend towards 1, because you're going to have some betas that are higher than 1, some are lower than 1. However, if you have a portfolio that's tailored to a market portfolio and tracks a benchmark, for example, and it tracks it exactly the same, you've got to believe that therefore the summation of the weighted average of each one of those betas from each one of the stocks equals 1. So therefore, look at beta is actually helpful, and CAPM has provided us with that opportunity to be able to analyze the betas of stocks. So if we assume that what's the beta of the market is really the covariance of the market to itself divided by the standard deviation squared of the market. So you end up with the standard deviation over itself, and that of course equals 1. So mathematically it makes sense. However, if we look over here and we look at the security risk premium, the security risk premium based on our previous equation, we're taking out the risk-free rate and we're taking out any kind of error rate. The actual risk premium of a security, therefore, is just the beta to the excess returns of the market over the risk-free rate. So what the CAPM is really stating is that the securities risk premium is directly proportional to the beta, all right, the beta and the risk premium of the market over the risk-free rate. And really this return beta relationship is portrayed as a security market line. So here we have a security market line. Once again, you've got your returns on the stock right here. You've got your risk-free rate at the bottom and your market return. And instead of at the bottom here having your variances or your standard deviation, you're going to put the beta. And what we're going to have here is the line, or the security market line, is the slope is determined once again by the market risk over the risk-free rate. So the higher your beta, of course, the steeper the line's going to get, but ultimately it's going to dissect where the market equals beta 1. So the return on the market where beta equals 1, that has to equal your efficient portfolio or your efficient market. So this is showing the relevance of beta to being able to determine the contribution of a stock to the efficient portfolio and to the market portfolio.